Imagine a company that started with a simple idea, bringing people together through video games. Then, almost like magic, it built an entire digital world around those players, a world where you can shop for anything, pay for everything with a tap, and even access a loan all while transforming into a hugely profitable powerhouse. Sounds like something straight out of a futuristic Silicon Valley blueprint, doesn't it? Well, today we're taking a deep dive into exactly such a company, Sea Limited, trading on the NYSE under the ticker SE. This isn't just any company, it's a Singapore based internet giant that sits right at the pulsating heart of Southeast Asia's booming digital economy. Their journey is a truly incredible saga of bold pivots, explosive growth, and most recently, a dramatic and highly successful turnaround to sustain profitability.
Indeed, it's a fascinating narrative of adaptation and strategic genius. We've pulled together a comprehensive stack of sources for this deep dive. Everything from granular analyst reports and company earnings calls right through to insightful investment theses. Our mission today is to unpack Sea Limited's full journey, help you understand its three core businesses, analyze the intense competitive landscape it navigates, and consider the powerful macroeconomic forces shaping its future. Ultimately, we want to equip you with a comprehensive and nuanced understanding of this powerful regional player. We'll even explore some differing views on its current valuation so you can connect the dots and form your own informed opinion.
Yeah, and what immediately jumps out at me is how Sea Limited perfectly embodies that classic, almost archetypal tech narrative. Aggressive expansion at all costs, burning through cash in pursuit of market dominance, followed by a sudden, almost brutal pivot towards ruthless efficiency and surprisingly rock-solid profits. It's not just a story of growth, it's a compelling masterclass in strategic adaptation when faced with shifting market realities. Okay, so let's unpack this incredible journey because Sea Limited didn't begin as the multifaceted giant it is today. It actually started in a very focused niche, gaming. Picture this. It's 2009, and Forrest Lee, a Stanford MBA graduate originally from Tianjin, China, founds a company in Singapore. His initial vision was Garena, short for Global Arena, a platform designed to distribute games and create a social hub for gamers. Their early strategy was incredibly smart. Instead of trying to build everything from scratch, they focused on localizing popular Western games like Riot Games' League of Legends, tailoring them specifically for Southeast Asian gamers. This wasn't just translation, it was about understanding local culture, preferences, and building a vibrant community. They quickly forged key partnerships with major players like Riot Games and Electronic Arts, establishing a strong foothold.
Right, and that early success, it really caught the eye of Tencent Holdings, the Chinese tech behemoth. They became a strategic early investor in the early 2010s, eventually holding about 22% pre-IPO. This wasn't just about the capital, though that was crucial. It also cemented a long-term alliance.
So by 2014, Garena's rapid rise was undeniable.
Absolutely. It was valued at approximately $1 billion by then, which, made it Singapore's first tech unicorn and, according to The Economist, the largest internet company in the country. That's a pretty strong start for just a gaming platform.
Definitely. But what's truly fascinating here, as you said, is that they didn't just stick to gaming.
Exactly. They had their finger on the pulse of a massive trend, the shift to mobile first. Sensing this, they made a really bold and ultimately transformative leap. In 2015, they launched Shopee.
Shopee, okay.
Yeah, a mobile-first consumer-to-consumer e-commerce platform, clearly inspired by the success of companies like Alibaba. Shopee's rapid growth wasn't accidental. It was driven by an incredibly intuitive, chat-based user experience, integrated social features that really resonated in the region, built-in payments to simplify transactions, and smart logistics partnerships that solved a huge pain point in fragmented Southeast Asian markets.
And it worked pretty quickly, right?
Oh yeah. Within just 3 years, Shopee had become the top e-commerce platform in several Southeast Asian markets. Around the same time, Garena started quietly testing AirPay, a payment service. This was a crucial early step, laying the groundwork for what would soon become C-Money, their powerful fintech arm.
Ah, the beginnings of the finance piece.
Precisely. And this burgeoning ambition was fully formalized in May 2017. After securing a significant $550 million funding round, the parent company, Garena, underwent a major corporate rebranding. It adopted the name Sea Limited, a clear and strategic nod to its primary focus region, Southeast Asia, and, well, to better represent its diverse and rapidly expanding businesses.
Across digital entertainment, e-commerce, and financial services.
Exactly. This new name really signaled their aspiration to become a comprehensive consumer internet conglomerate, much like a regional Tencent or Alibaba. That same year, in October 2017, Sea Limited made its debut on the New York Stock Exchange, the NYSE, raised $884 million at an IPO price of $15 per share, valuing the business at roughly $4 to $5 billion.
Wow, quite a jump. And that capital injection was key.
Absolutely vital. Primarily fueled Shopee's aggressive expansion across the region and enabled Garena to ramp up its internal game development efforts. And that investment paid off quickly because it was also around this time that Garena launched its first major proprietary game, Free Fire.
Ah, Free Fire. That became huge, didn't it?
Huge. Initially, some might have dismissed it as a low-budget PUBG clone, maybe, but it became a surprising global phenomenon, especially in emerging markets like Latin America, Southeast Asia, and India. Its lightweight design meant it ran smoothly on lower-end smartphones, its fast-paced gameplay was addictive, and its localized content truly resonated.
So that reduced their reliance on third-party games.
Significantly, it proved Garena's ability to create its own blockbusters.
Okay, so they had successfully built this massive gaming presence with Garena. They had launched an incredibly fast-growing e-commerce platform with Shopee. And then, as you mentioned, came the crucial piece that really connected all those dots, because this finance.
Right. From 2018 to 2019, Sea Limited focused intently on building out this integrated ecosystem. They formally launched Sea Money, which, while initially designed to facilitate transactions within Shopee via AirPay, quickly expanded its scope. It began offering digital wallets, payment gateways, and even microloans, directly addressing the huge unbanked population across Southeast Asia.
People who traditionally lacked access to formal credit, right?
Exactly. By 2020, this flywheel strategy, as we often call it, was in full effect, becoming a self-reinforcing loop. Garena acted as the powerful user acquisition engine, drawing millions into the broader Sea ecosystem, often for free. Shopee then effectively monetized that attention, converting users into e-commerce transactions. And Sea Money, crucially, captured the payment volume from these transactions, along with invaluable financial data.
Which allowed for even more sophisticated credit scoring and tailored financial products.
Precisely. This integrated approach was clearly working wonders. Revenues skyrocketed from, $400 million in 2017 to an impressive $4.3 billion by 2020.
That's staggering growth.
It really was. And they weren't just relying on organic growth either. They strategically raised billions more through follow-on offerings. That funded even more rapid expansion, including Shopee's ambitious entry into Latin America, starting with Brazil. By the end of 2019, Sea's balance sheet was robustly fortified, with billions in cash, strategically positioning them to seize bigger opportunities and, as it turned out, to weather some unforeseen global challenges.
Including the looming COVID-19 pandemic.
Exactly.
And then, as the entire world knows, the COVID boom hit. The years 2020-2021 were a truly massive catalyst for Sea Limited, weren't they?
Unbelievable catalyst. Lockdowns across Southeast Asia turbocharged their growth beyond anyone's wildest expectations. Shopee became the most downloaded app in the region. Its gross merchandise value, or GMV, that's the total value of all goods sold, and just soared.
And Garena's Free Fire?
Free Fire surpassed an incredible 100 million daily active users. Its bookings, essentially the total sales of in-game content, topped an astounding $1 billion for the year.
Wow. And this explosive growth obviously hit the stock price.
Oh, dramatically.
Yeah.
The market capitalization surged from $15 billion to over $200 billion by late 2021, briefly making Sea the most valuable company in all of Southeast Asia.
Incredible. And Sea Money, the fintech arm, kept pace.
It ramped up significantly, secured a digital full bank license in Singapore in December 2020, acquired Bank BKE in Indonesia, rebranded it Seabank, obtained a Malaysian digital bank license, rapidly built out Seabank Philippines. The results were staggering. Sea Money's revenue rose an incredible 155% year-on-year in 2021.
So they needed more fuel for this fire.
Right. They raised a massive $6.3 billion in Southeast Asia's largest equity offering in September 2021, bringing its cash reserves to a staggering $13 billion. Shares peaked at an astonishing $372, valuation north of $200 billion.
And with this substantial war chest, they went global.
Aggressively. Expanded Shopee beyond ASEAN into Europe. Poland, Spain, France even entered India, deepened their presence in Latin America, launching in Mexico, Chile, Colombia. This was truly a growth-at-all-costs era.
Characterized by huge spending, right? I remember the Cristiano Ronaldo ads for Shopee.
Yes, exactly. High-profile marketing. In 2021, revenue grew a mind-boggling 127% to $10 billion. But this came with net losses exceeding $1.6 billion. While this aggressive model was largely accepted during the pandemic boom, when investors prioritized market share, concerns about its long-term sustainability were definitely beginning to emerge beneath the surface. And this is where the story gets really compelling, because after that period of explosive, almost unchecked growth, Sea Limited faced a series of significant headwinds. It forced a dramatic and urgent strategic shift.
Right. Things started to change in early 2022.
They did. First, Tencent, amidst China's escalating tech crackdown and a broader de-risking strategy, reduced its stake in Sea by $3 billion, dropped from 21% to 18.7%. This move, while maybe understandable for Tencent, sent Sea's stock tumbling 11% in a single day, signaled investor unease.
But that wasn't the worst of it, was it?
No, a far more severe blow came swiftly in February 2022. India banned Garena's Free Fire, citing national security concerns over Chinese-linked apps. This was critical. Despite being Singapore-based, its historic ties to Tencent led to its inclusion in the ban.
And the market reaction.
Violent. This single event wiped a staggering $16 billion in market value and 18% drop in one day. Free Fire lost one of its absolute biggest markets. These external shocks were then compounded by Shopee's strategic retreat.
Yeah, they pulled back pretty quickly.
Very quickly. March 2022, just 5 months after launch, Shopee withdrew from India, citing global market uncertainties, followed by exits from France and Spain by Q2 2022, a clear, painful step back from global ambitions.
And financially, the momentum reverts.
Terribly. Shopee's year-on-year revenue growth slowed to just 21% in Q2 2022. Stark contrast to the triple digits of 2021. Garena's revenue, hit by normalizing demand post-pandemic and the India ban, fell a dramatic 40%. The aggressive, high-cost expansion model. It just became unsustainable as growth stalled and capital got more expensive.
So this was clearly a crisis point. What did this dramatic shift mean for the company's direction? I understand CEO Forrest Ly's message to staff was incredibly stark, almost a rallying cry: survival.
That's exactly right, survival mode. In June 2022, CEO Forrest Ly announced a critical pivot from growth at all costs to a relentless focus on profitability.
Which meant cuts.
Major cost cuts. Froze hiring, dramatically slashed marketing, laid off approximately 7,000 employees, roughly 10% of the workforce across Shopee, Garena, and C-Money. And to underscore the commitment, Ly and other senior execs waived their salaries and bonuses until the company reached self-sustaining cash flow.
Leadership buy-in from the top.
Absolutely. This period also saw a strategic retreat in investment activities. C Capital, their investment arm, was discontinued to conserve cash. Shopee further consolidated, reverting to cross-border in Chile, Colombia, Mexico, completely exiting Argentina, shut down Poland by January 2023.
So retrenching to the core.
It's exactly. Focusing on the most successful core markets: Southeast Asia, Taiwan, and crucially, Brazil. Brazil proved to be the one major overseas market where Shopee kept strong traction in local operations. This wasn't just cost-cutting. It was reprioritizing sustainable unit economics over vanity growth. A tough lesson learned.
Shows real adaptability, though.
It does. And the discipline started showing results with remarkable speed. By November 2022, those austerity measures began to bear fruit, operating losses narrowing dramatically. In a pivotal moment, Shopee's core Southeast Asia and Taiwan e-commerce business actually turned adjusted EBITDA positive for the first time ever.
Adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, a key measure of core operating performance.
Exactly. Gives a clearer picture of underlying efficiency. Investors reacted incredibly positively. C stock jumped an impressive 36% in a single day after the Q3 2022 results. Especially significant considering the stock had cratered to around $40 by mid-October 2022, down 85% from its peak. It signaled renewed confidence in the profitability pivot.
And they achieved it. Full profitability.
By 2023, yes. C posted its first GAAP profit that's generally accepted accounting principles in Q4 2022. And for the full year 2023, earned $162.7 million in net income. Both Shopee's SEA arm and C-Money had turned EBITDA positive, discipline paying off across the board.
What about Garena during this time?
Garena stabilized after a tough 2022. Free Fire remained incredibly resilient, hitting over 100 million daily active users again by early 2024, boosted by content refreshes like a very successful Naruto crossover. While revenue stayed below peak 2021 levels, Garena continued to be a crucial cash cow, generating strong adjusted EBITDA. That was vital for funding other segments as they rebuilt.
So they could reinvest even with slower overall growth.
Right. Despite overall revenue growth slowing temporarily, Q-tier 2023 was just 5.2% up. Seed strategically reinvested in Shopee to regain momentum. They accepted short-term losses in some areas to secure long-term market share. And that calculated move paid off beautifully. Shopee's orders surged 46% year-on-year by Q4 2023. And by Q3 2024, Shopee had achieved profitability in both Asia and Brazil operations, a full-circle return to sustainable, profitable growth. So if we connect this to the bigger picture, what we're witnessing now is a company that hasn't just survived a brutal market correction, but has emerged significantly stronger, demonstrating what Forrest Lie aptly called profitable prime. It's not just survival, it's thriving with a new, efficient DNA.
Okay, let's look at the recent numbers, the overall financial health.
It tells a very compelling story. For the full fiscal year 2024, C reported total JAP revenue of $16.8 billion. That's a robust 28.8% year-on-year increase. Profitable for the second consecutive year, net income of $447.8 million, up significantly from $162.7 million in 2023. Net margin about 2.7%.
And adjusted EBITDA
Reached $2 zillion, up substantially from $1.2 billion in 2023. Clear indication of vastly improved operating leverage, getting more profit per dollar of revenue.
And this strength continued into 2025.
Absolutely accelerated.
Yeah.
Q1 2025, JAP revenue $4.84 billion, up 29.6% year-on-year.
Yep.
Net income $411 million in just one quarter. Nearly the entire net income of FY 2024 achieved in 3 months. Reversed a $23 million loss from Q1 2024. Adjusted EBITDA more than doubled to $947 million. All three segments contributed positively to free cash flow.
Wow, and Q2.
Q2 2025 solidified the trend. JAP revenue soared to $5.3 billion, up 38.2% year-on-year, beating estimates by 5.7%. Gross profit surged 52.1% to $2.4 billion. Net income dramatically rose to $414.2 million, up from $79.9 million in Q2 2024. Net margin improved significantly to 7.9%. That's 5.8 percentage points higher year-on-year. Adjusted EBITDA $829.2 million, up 84.9% year-on-year. Operating cash flow margin surged to 30.7%. Very strong cash generation.
And they have the cash reserves to back this up.
Rock-solid balance sheet. As of June 30, 2025, cash, equivalents, short-term investments totaled $10.6 billion. Net cash position, after considering debt, around $7 billion. A substantial war chest for flexibility.
What about expenses? Are they keeping costs down?
Yes, consistent improvement. Sales and marketing, R&D, G&A expenses as a percentage of revenue have consistently declined. For example, Q2 2025, sales and marketing was 19.2% of revenue, down 1.2 percentage points year-on-year. Clear indicator of improved operating leverage, leaner cost structure. Management's outlook is confident.
Prioritizing growth but maintaining efficiency.
Exactly. Expect Shopee GMV to grow around 20%, Garena bookings over 30%. They raised that guidance, and Money's loan book continuing rapid expansion in 2025.
Those numbers are truly impressive. A clear picture of a thriving company. But let's bring it down to the ground level. What's actually happening within each of the three core businesses? Let's start with Shopee, the e-commerce arm. Shopee, as you said, undisputed market leader in Southeast Asia and Taiwan. Capturing 30–50% of online retail traffic, over 62% market share by GMV. That level of dominance is higher than Amazon or Mercado Libre in their home regions, right?
That's right. It's quite remarkable. Beyond Asia, Shopee is also the third largest online marketplace in Brazil. Estimated $15 billion GMV in 2024, about 15% market share. They've built something exceptional there.
And the recent growth metrics for Shopee specifically.
Compelling. Q2 2025, GMV $29.8 billion, up 28.2% year-on-year. Gross orders $3.8 billion, up 28.6%. GAAP revenue $3.8 billion, up 33.7%. And the turnaround, adjusted EBITDA of $227.7 million, a huge swing from a $9.2 million loss in Q2 2024. Shopee is now profitable in both Asia and Brazil.
Monetization and efficiency must be key drivers.
Absolutely. Core marketplace revenue, transaction fees, and advertising up 46% year-on-year in Q2 2025 to $2.6 billion. Ad revenue surged over 50% year-on-year in Q1. More sellers buying ads, spending more per seller. Ad take rate improved to around 2%.
Still lower than Amazon or Mercado Libre, though. Potential upside there.
Definitely. Their take rate is closer to 7% plus ASD. Significant room for Shopee to grow ad revenue. They're also heavily investing in AI tools. AI assistant for sellers, GMV Max for ads, internal efficiency, fraud detection, all tied to measurable KPIs. Very disciplined.
And logistics, Shopee Express, SPX, that's a big differentiator.
Huge. SPX is now the second largest logistics player in Southeast Asia. In-house control leads to cost efficiencies. Logistics cost per order dropped 6% in Asia, 21% in Brazil, year-on-year in Q1 2025. Further reductions in Q2. Delivery speed significantly improved, 2-3 days faster in Brazil. Piloted instant delivery in Indonesia. Rolled out to Vietnam, Thailand. Using AI for demand forecasting too.
What about keeping users engaged and loyal?
Very high focus there. Campaigns like Cheaper, Faster at Shopee boosted purchase frequency over 10% in Q2. Their Shopee VIP membership program had 2 million subscribers by June 2025 across Indonesia, Thailand, Vietnam. VIP members buy 3x more often, spend 4x more, 20% higher retention. Highly valuable.
And the content side, live streaming, videos.
Thriving. Orders from live streaming and short-form videos made up over 20% of total physical goods order volume in SEA in Q2 2025. They partnered with YouTube Shopping too. Indonesia, Thailand, Vietnam. Over 7 million videos featuring Shopee product links by June. Marries YouTube's audience with Shopee's fulfillment.
Clever. And Brazil, still a success story.
Remarkable success. 5-year anniversary, market leader by order volume, growing fast, profitable, also promoting digital entrepreneurship for over 8 million Brazilians. 30% cite Shopee as their first online selling experience. 50% plus rely on it as primary income. Powerful localization. That's a huge point about Shopee's leadership. But let's pivot to Garena, because this raises an important question. Can a gaming company, often seen as hit-driven, really sustain engagement for nearly a decade with one flagship game? Free Fire seems to be proving it can.
Yeah, it's quite the feat. Garena's digital entertainment arm has definitely seen a powerful resurgence.
Its flagship, Free Fire, remains the world's #1 mobile game by average daily active users, DAU, and downloads, according to Sensor Tower. It's truly an evergreen franchise, now incredibly in its 8th year.
And the recent metrics for Garena?
Strong. Q2 2025 bookings, total player purchases were $661.3 million, up 23.2% year-on-year. They actually raised full-year 2025 guidance to over 30% year-on-year bookings growth. Shows confidence. JAPA revenue, $559.1 million, up 28.4%. Adjusted EBITDA, $368.2 million, up 21.6%, representing a very strong 55.7% of bookings. Incredibly efficient cash generator.
User engagement holding up too.
Robust. Quarterly active users, QAUs, 664.8 million, up 2.6%. Quarterly paying users, QPUs, 61.8 million, up a significant 17.8%. Pushes the paying user ratio to 9.3%, up from 8.1% year prior. Average bookings per user, ARPU, improved to 99 cents.
What's driving this sustained engagement? Content, collaborations.
Both. Relentless focus on fresh content and strategic collaborations. The Naruto Shippuden collab in Q1-Q2 2025 generated over 300 million video impressions, highest rated collab ever. Brought DAU close to peak pandemic levels. Launched a new map, Solara, for the 8th anniversary. Blended nostalgia with innovation, became their best performing new map. New camera mode increased daily sharing of in-game footage nearly 4x. Boosting social visibility.
Other IP collaborations too, like Squid Game.
Yeah, Squid Game's second chapter of Naruto consistently improved retention and monetization. Plus, hyperlocal campaigns, Ramadan missions in Indonesia, temple blessings in Taiwan, deep understanding of local cultures.
Are they diversifying beyond Free Fire?
Actively. Published Delta Force Mobile in April, over 10 million downloads already. Pre-registration open for Free City, an open-world in-house developed game. And using AI integration, cleverly reducing development timelines, enhancing asset quality, personalized experiences, even testing AI teammates. Very forward-thinking.
That's a brilliant breakdown of Garena's resilience. Now let's move to money, because what started almost as a utility for Shopee has absolutely exploded. It's one of C's fastest growing and most profitable engines now, right?
Absolutely. This segment, formerly C-Money, strategically rebranded to Money in early 2025, better reflects its consumer-focused fintech brand identity, spans mobile wallets, consumer credit, digital banking.
And the growth metrics for Q2 2025 must be impressive.
Astounding, frankly. JAP revenue hit $882.8 million, a phenomenal 70.0% year-on-year increase. Adjusted EBITDA, $255.3 million, up 55.0%, maintaining a very healthy 30% EBITDA margin. Loan book expanded to $6.9 billion, that's up 90% year-on-year, includes $5.9 billion on book, $1.9 billion off book. Active borrowers exceeded 30 million, up 45% year-on-year. Added over 4 million first-time borrowers in Q2 alone.
Wow. But with that massive growth, what about credit quality, loan defaults?
That's the crucial part. Despite massive growth, Money's 90-day non-performing loan NPL ratio remains remarkably stable at 1.0%, actually slightly down from 1.1% in Q1 2025.
Yeah.
Indicates incredibly robust risk management even while scaling so rapidly.
And product expansion is key too?
Yeah.
Shopee, Pay Later?
Definitely. Shopee, the mobile wallet, often ranks among top digital wallets. Standalone apps surpassed 30 million downloads in Indonesia. Pay Later, their Buy Now Pay Later, BNPL, is a major driver. 1-month interest-free option, tier-based pricing, users can request higher limits. BNPL penetration now in the mid-teens across their regions.
Are they expanding Pay Later beyond the Shopee platform?
Yes, off Shopee's Pay Later is growing healthily. integrated with national QR networks like Malaysia's Do It Now, Thailand's Prompt Pay, shows ambition beyond their own ecosystem. Personal cash loans almost doubled year on year, scaled quickly and profitably by cross-selling to SpayLater users with good repayment trends, expanded into higher-ticket financing like smartphones, motorbikes,
And the digital banking licenses.
hold full digital bank charters in key markets.
Huh.
Singapore, Merabank launched 2023. Indonesia, Cbank, Philippines, Cbank. Malaysia's loan book just surpassed $1 billion third market after Indonesia and Thailand to hit that milestone.
So what really makes money so powerful? What's their competitive advantage?
It's multifaceted. First, deep integration, seamlessly embedded in the massive Shopee ecosystem. Captures transactions right there. Second, their data-driven underwriting is revolutionary, leveraging incredibly deep, granular data from Shopee and Garena's SKU-level spending, repayment cadence, even free-fire top-up behavior.
Wow, using gaming data for credit scoring.
Yeah. It builds a proprietary AI-powered credit scoring system that lets them undercut traditional banks' default rates by up to 40 basis points. Incredibly efficient and precise lending. Third, diversified funding. Exploring collaborations with financial institutions, structured products like asset-backed securities, ABS, beyond just their own cash.
What about Brazil for money?
Strong loan growth there, too, supported by Shopee's penetration at high interest margins. Open finance integration, improving underwriting. BNPL penetration still in single to low double digits there, so substantial growth potential remains. Hashtag 4. Competitive landscape and sees strategic advantages. That's an incredibly comprehensive look at Money's unique position. Now, this all leads us to a crucial aspect. In such high-growth, dynamic markets like Southeast Asia and Brazil, who is C-Limited truly up against? And how does it manage to maintain and even expand its considerable edge?
Right, the e-commerce battleground must be intense, especially in Southeast Asia. Who are the main rivals?
Historically, the primary competitor has been Lazada, backed by the formidable Alibaba Group. Lazada benefits from Alibaba's capital, tech, Alipay, Cainiao logistics, but Shopee has significantly outrun it recently. Shopee's SEA GMV was around $55.1 billion in 2023, roughly 3 times Lazada's $18.8 billion.
Wow, that's a big gap.
It is. Lazada remains strong in cross-border e-commerce, but Shopee countered with its own China marketplace portal. A newer, arguably more disruptive entrant is TikTok Shop from ByteDance.
Ah, yes, the content commerce fusion.
Exactly. Shoppable videos, live streams. Reached an estimated $16 billion GMV in SCA in 2023. Interestingly, Indonesia's ban on social commerce sales in late 2023 directly benefited Shopee and local rival Tokopedia, removing that threat for a time.
And Shopee's response to TikTok Shop.
Double down on in-app live streams and short-form video, over 20% of order volume now. And that YouTube shopping partnership we mentioned. In Indonesia specifically, Shopee faces formidable local rival Tokopedia, part of the GoTo group. It's essentially a duopoly.
Shopee around 40% GMV share, Tokopedia 35%.
Roughly, yeah. Tokopedia's strengths are deep penetration in second-tier cities, strong brand trust, GoPay e-wallet, and Gojek's driver network for same-day delivery.
Okay, shifting to Latin America, Brazil. The big player there is Mercado Libre.
Milei, exactly. The Amazon of Latin America, dominant with 50% plus market share in Brazil. Shopee Brazil, despite being newer, has grown rapidly. Market leader by order volume, focusing on affordable products, gamification. But Milei has superior logistics with Mercado Envios and deeper financial services via Mercado Pago. Milei's recent move to slash free shipping minimums directly targets Shopee. It's a fierce battle.
What about gaming? Garena's Free Fire faces stiff competition too, right?
Definitely. Directly competes with Krafton's PUBG Mobile and BGMI in India in the Battle Royale genre. Tencent Games, an investor in C, but also parent of Riot Games, is a massive global player and indirect competitor with huge titles like Honor of Kings, League of Legends, Valorant, and Moonton, owned by ByteDance with Mobile Legends. Bang Bang, MLBB, dominates the MOBA genre NCA.
So Garena's strategy.
Free Fire's success hinges on targeting emerging markets, lower-end devices, deep localization, constant content, aggressive community building, and as we discussed, actively diversifying with new titles like Delta Force Mobile and Free City.
And FinTech Money operates in a FinTech gold rush. Who are the main competitors there?
For payments, it's fierce. Other super app e-wallets like GrabPay, GoPay, standalone fintechs like Dana, OVO. Competition is about increasing wallet share. Shopee's key edge is its deep embeddedness in the most used shopping app.
And for lending and digital banking.
New digital banks, GrabSingtel's GXS Bank, GoTo's Bank Jago, plus incumbent banks. In Brazil, well-funded players like Nubank with 100M plus customers, and Mercado Pago, Milei's fintech arm. Very strong competition.
That money has its moat.
A formidable one. Deep integration with Shopee Garena ecosystems, vast user base with growing credit records, proprietary AI credit scoring using that unique data, multiple digital bank licenses, and scale. Money's $6.9 billion loan book, significantly larger than, say, Grab's $566 million, shows leadership.
Here's where it truly gets fascinating for C. How all their individual businesses feed into each other. This flywheel effect you mentioned earlier. Can you unpack how that truly works in practice?
Absolutely. The flywheel is the secret sauce here. Think of it as a self-reinforcing loop. Garena, the gaming arm, acts as the initial magnet, attracts millions of users, often for free, through games like Free Fire. Once users are in, Shopee steps in, converts that attention into e-commerce transactions, monetizing their interest, and then, crucially, money captures the payment volume and generates invaluable financial data from all those e-commerce transactions, even in-game purchases.
And that data feeds back into the system.
Exactly. Enabling more precise credit scoring, developing more tailored financial products, further embedding users. This data-rich feedback loop also enhances ad targeting. Fraud detection, it just compounds over time, dramatically lowers their blended customer acquisition costs. Because once a user is in one part, it's easier to cross-sell to another. Creates an incredibly robust competitive moat, exceptionally hard for standalone rivals to replicate because they don't have all those interconnected data points.
So if we pull all that together, what would you say are C's overarching competitive advantages that truly set them apart?
Well, first, commanding leadership positions. Shopee, #1 in SEA, Free Fire, a global mobile leader. Second, incredibly strong regional focus, deep understanding of Southeast Asian consumers, built for local preferences. Third, that sizable cash reserve, $10.6 billion, provides a war chest for investment, innovation, or weathering price wars. Fourth, the integrated ecosystem, that flywheel effect, creates genuinely high barriers to entry, hard to replicate. And finally, their demonstrated ability to continually innovate AI, seller tools, user features, coupled with a relentless focus on optimizing costs, keeps them agile and responsive. #Hive. Macroeconomic and demographic tailwinds risks.
Okay, that paints a very clear picture of C's internal strengths and competitive position. But what about the broader environment? Are the macroeconomic winds at their back, or are there storms on the horizon?
Overwhelmingly, the winds are at their back, especially long-term. The macroeconomic and demographic tailwinds in both Southeast Asia and Brazil are incredibly strong and structural.
Starting with the population.
Exactly. Young and growing. Over 600 million people in SEA, median age, mid-20s, early 30s in many countries. Massive digitally native user pool projections. Over 402 million Southeast Asians engaging in online commerce by 2027. They're digital natives.
And the middle class is expanding.
Right. Rising disposable incomes boost demand for e-commerce, digital entertainment. Millions moved into lower middle class, increasing demand for affordable online goods, digital services. Third, internet and smartphone penetration are rapidly accelerating. 85–90% internet penetration in markets like Malaysia, Singapore. Critically, 89% access via smartphones. Mobile-first strategy aligns perfectly. Millions more coming online yearly.
Plus strong economic growth and urbanization.
Yeah, ISI is a global growth bright spot. Indonesia, 5% GDP growth. Philippines, 5–6%, consistently outpacing developed economies. Urbanization accelerating too, over 45% in urban areas by 2030. Expands e-commerce reach and density.
And the pandemic's lasting impact.
Paradoxically, it catalyzed digital adoption. Structurally shifted consumer behavior online. Digital services became a necessity. Southeast Asia's internet economy forecast to exceed $300 billion by 2025. Finally, infrastructure improvements, roads, delivery networks, 4G, 5G, real-time payment systems like Prompt Pay, Pay Now, all reduce friction. E-commerce penetration in SEA still only around 20% of retail, excluding food. Significant room for growth compared to over 30% in China. Long runway ahead.
Okay, those tailwinds are powerful. But while the long-term trends are positive, this raises an important question. What are the potential headwinds or specific risks, especially given the global political climate?
That's a crucial point. One significant and very current risk involves geopolitical tensions and potential tariffs. As of April 2, 2025, President Trump announced sweeping new import tariffs. 10% baseline on all U.S. imports, steeper reciprocal rates for dozens of countries. Southeast Asia, unfortunately, is among the hardest-hit regions under these proposed tariffs. Vietnam facing 46% U.S. tariff, Thailand 37%, Taiwan 32%, China 54%.
And the immediate impact?
Market turmoil. Weakened currencies like the Vietnamese dong, Thai baht, plunging stock indices in affected countries. Now, the impact on Shopee, while indirect, is significant.
How so? Regional economic stress.
Yes, potential export losses, job losses, slower economic growth in key Shopee markets like Vietnam, Thailand, Taiwan could lower consumer spending power. Eroding local currencies could also raise import costs for goods on Shopee, dampening demand. Analysts also warn of global supply chain disruption, shipping delays, inventory imbalances, higher freight costs for Shopee's logistics could challenge the China Plus One sourcing strategy.
What about Garena and Moni?
For Garena, deteriorating economic conditions could reduce discretionary spending on in-game purchases. Might temper growth. C-Money faces mixed impacts. Higher inflation interest rates could slow digital payment credit growth, raise loan default risks. Conversely, might see increased digital wallet adoption if consumers seek online bargains during tougher times.
And operationally?
Unpredictable trade policies make long-term planning very difficult. CE might need to support more local sourcing. Geopolitical tensions could impact Chinese tech investment in SEA too, short-term. Heightened volatility for SE stock, potential downgrades or reduced growth forecasts. Long-term depends on de-escalation versus protracted trade war. C's strong balance sheet and diversified model provide resilience, could adapt by focusing more on less affected markets, like Brazil, which faces only a 10% U.S. tariff currently.
Right. And just to be clear, we're reporting on the potential implications from analyst sources here, not taking any political stance.
Exactly. We're just conveying the potential economic impacts discussed in the source material. Beyond tariffs, other risks are always present. Ongoing competition is constant. Price wars could reemerge, pressuring margins like in 2023. The regulatory environment across SEA is a patchwork, constantly evolving. Indonesia's TikTok shop ban helped C, but future rules could cap interest rates for money or limit game time for Garena.
Execution risk must be huge, too, managing so many markets and businesses.
Definitely. 9 core e-commerce markets, cross-border fintech, Brazil expansion, global gaming franchise. Talent retention is crucial. Garena's reliance on Free Fire carries cyclical risk, though they're diversifying. Sustainability of growth in Latin America, balancing profitability with growth against MELI, and, of course, key man risk around Forest Lie, though Chris Fang is seen as a strong successor. ###6. Investment outlook and concluding thoughts.
So we've navigated through Sea Limited's incredible journey, their current strength, the competition, the macro environment. What does this all mean for its future, particularly from an investment perspective? Let's unpack the bull thesis, maybe starting with the gap growth perspective from mid-2025.
Okay, the bull thesis. First, gap growth emphasizes Shopee's e-commerce leadership. Undisputed leader in TCA, 62% market share, higher than Amazon MELI in their regions. Creates strong network effects, moats. Second, Garena's second wind, Free Fire as an evergreen franchise, driving strong cash flow. New titles like Delta Force Mobile, Free City offer diversification, upside. Third, Money's fintech flywheel, explosive growth, low NPL ratio, 1.1%, leverages Shopee Garena data for superior credit scoring, digital bank charters, secure long-term potential.
And the integrated flywheel effect itself.
Considered crucial. The synergy between Shopee, Garena, Money creates a compounding effect, traffic, data, monetization, exceptionally hard for rivals to replicate. Fifth, the profitability inflection point. Dramatically improved marketing efficiency, rising gross margins, 44%, operating leverage. All 3 segments profitable in Q1 2025, often triggers market re-rating.
Plus leadership and optionality.
All right, visionary founder-led execution. Force Lie's track record of majority voting rights allow long-term strategy, and significant upside optionality. Shopee's ad business, low 3% take rate versus 7% plus for Amazon MELI offers billions in incremental profit. New vectors, YouTube Shopee integration, microinsurance or robo-advisory via Money, SPX opening to third parties. Finally, those huge demographic and macro tailwinds in SEA and Brazil. Structural growth runways.
A very compelling bull case. But this is where opinions on valuation often diverge, right? It's important for listeners to hear both sides.
Absolutely crucial. We have gap growth seeing significant upside, while another analyst, Parkev Vojan, sounds a distinct note of caution. Gap growth's sum of the parts valuation from May-June 2025 is bullish. Values Shopee core e-commerce and logistics at $16 to PCV, Shopee ads VAS at $46 to PCV, using Amazon ads as blueprint, Garena $30 EV, Money $16 per share, total EV $108.04 at 90 cents, add net cash, 7 EV $115.04 or roughly $193 per share. Implied upside of 27% from the $153 price then. Gap growth called this a very conservative base case.
Okay, what about the more cautious view? Parkev Vojan.
His discounted cash flow DCF valuation on March 5, 2025 found an intrinsic value per share of only $51, significantly lower than the market price of $143 at the time. led him to downgrade to borderline buy.
What was his reasoning for that much lower valuation?
Several points. The rapid share price increased itself up 5x from his initial recommendation, suggesting the valuation got rich or expensive. He noted C is capital intensive, not primarily high-margin software, which typically gets lower valuations. Being non-U.S. implies a discount for some, given geopolitical tensions. And crucially, return on invested capital ROIC was still only 1%, significantly below its weighted average cost of capital WACC of 12.3%.
Meaning they weren't generating enough profit from their investments to cover the cost of that capital.
In simple terms, yes. A key metric for long-term value creation wasn't being met at that point. So two very different perspectives on intrinsic value, offering important context for your own considerations.
That's a crucial distinction and really helpful to hear both sides. So after this incredible deep dive, it's clear that Sea Limited has truly navigated from those stormy waters to much clearer seas, unequivocally proving its adaptability and impressive resilience. The company has successfully transitioned from being a cash-burning growth story to a disciplined, profitable regional champion.
Absolutely. Its commanding dominance in e-commerce, combined with that rapidly expanding and highly integrated fintech ecosystem, creates a formidable, self-reinforcing competitive moat. While competition will undoubtedly keep them on their toes, needing continued innovation, its strong financial position, combined with that deep alignment with powerful macroeconomic and demographic trends in Southeast Asia and Brazil, strongly suggests it can sustain this impressive momentum for years to come.
Considering Sea Limited's journey, which involved not just adaptation but also that willingness to shed non-core ventures and make incredibly hard cuts for survival and future profitability, it truly makes you wonder, what will be the next major invention of Sea Limited? And which of its current burgeoning ventures, from AI-powered logistics to those exciting new gaming IPs Garena is developing, will become the next multi-billion-dollar pillar for the company? What aspect of this entire deep dive stands out most to you as you reflect on their story?
Indeed, that narrative of constant evolution, of being willing to make those tough calls and adapt, isn't just key for C, but maybe a lesson for any business in this rapidly changing digital landscape. As always, the real deep dive continues in your own insights and considerations after listening to all this.